Silver just did something it hasn't done in 43 years. 10 consecutive green months. Not 9, not 8. 10 straight months of gains. And this morning at 8:30 a.m. Eastern, the PPI data dropped. The number that was supposed to calm inflation fears, it came in hot, 2.9% when they expected 2.6%. Core PPI, 3.6% against a 3.0% forecast. And silver went absolutely vertical. $92 Western spot right now. But here's what they're not telling you. This isn't just a rally. This is a pattern that's only appeared 3 times in modern history. 1979, 2011, and now. And every single time this pattern formed, what came next changed everything for those who understood it. Welcome to Currency Archive, where we read the signals before the crowd even knows they exist. Now I need something from you. If you've been in markets long enough to remember when financial news came once a day in the newspaper, when your broker was a real person you could call, when analysis meant more than watching a ticker scroll by, then I'm asking you, as a fellow student of real market history, hit that subscribe button. Not because I'm asking, but because what we're about to break down, the pattern behind these 10 green months, this might be the most important market signal you'll see this decade. And drop a comment, tell me where you're watching from. New York, London, Singapore, small town America? Because what's happening in silver right now, it's not just numbers on a screen, it's a wealth transfer playing out in real time. At 8:30 a.m. Eastern Standard Time on Thursday morning, a government economist pressed a button that released a single number to the world, the Producer Price Index for January, the number that measures what manufacturers and producers pay for goods before they reach consumers, a number that arrives every month, a number that most people ignore. This morning, that number changed everything. The expectation was 2.6%. Analysts had prepared their notes. Traders had positioned their bets. The consensus was clear. Inflation was cooling. The Federal Reserve's battle against rising prices was working. The data would confirm what everyone already believed. Then the number appeared on screens. 2.9%, higher than expected, significantly higher. But that was just the headline number. The core PPI, which strips out volatile food and energy prices and shows the underlying inflation trend, told an even more uncomfortable story. Expectations were for 3.0%. The actual number came in at 3.6%, a miss of 60 basis points. In the world of inflation data, that is not a rounding error, that is a signal. Within seconds, algorithmic trading systems processed the information. Within minutes, human traders confirmed what the algorithms had already executed. Within an hour, the entire precious metals complex was moving violently higher. Silver led the charge. By mid-morning, silver was trading at $92 per ounce in Western spot markets. This was not just another price increase. This was a specific technical level that traders had been watching for weeks. A resistance point that had held back previous rallies. A barrier that, once broken, would suggest something larger was unfolding. But the $92 price level, while significant, was not the real story. The real story was what had happened over the previous 10 months. The pattern that had been building while most market participants focused on daily price movements and missed the larger structure forming beneath the surface. Silver had posted 10 consecutive monthly gains. 10 green candles in a row on the monthly chart. No red months, no corrections, no pullbacks that lasted longer than a few weeks before the uptrend resumed. Just relentless, grinding month after month appreciation. To understand how rare this is, one must go back through market history. Silver is known for volatility. It rallies hard and crashes harder. It attracts speculation and then punishes speculators. Multi-month sustained trends without significant corrections are unusual in this metal. 10-month uninterrupted rallies are historically exceptional. The last time silver produced a 10-month winning streak was 1979. That year, silver went from roughly $6 per ounce in January to over $50 by January 1980. It was the most dramatic precious metals rally in modern history, driven by the Hunt brothers' attempt to corner the market, yes, but also by inflation running at double-digit levels and a crisis of confidence in fiat currency. Before that, one would need to search decades back to find comparable, sustained momentum. Silver simply does not behave this way often. When it does, the market is trying to communicate something about underlying conditions in the monetary system, in inflation expectations, in the relationship between paper currency and hard assets. The 10-month pattern meant that institutional capital was involved. Retail speculators do not create 10-month trends. They chase momentum for weeks, maybe months, and then get shaken out. Sustained multi-month rallies require persistent buying from entities with deep pockets and long-time horizons. Sovereign wealth funds, central banks accumulating reserves, large institutional investors repositioning portfolios away from traditional assets and toward inflation hedges. The PPI number released this morning did not create the 10-month rally. It confirmed it. It validated the positioning that sophisticated capital had already taken. It provided fundamental justification for a technical pattern that was already well established. Here is what the PPI data actually revealed. Producer prices were rising faster than the Federal Reserve's models predicted. This meant one of two things. Either producers were passing along higher input costs despite weak consumer demand, which would suggest stagflation, or consumer demand was actually stronger than official economic data indicated, which would mean inflation had more fuel ahead. Either scenario was bullish for precious metals. In a stagflationary environment, hard assets outperform. In a high-demand inflationary environment, hard assets also outperform. The PPI print did not tell market participants which scenario was unfolding, but it told them that one of these two dynamics was in play. Silver's response was immediate and technical. The metal broke through $92, a level it had tested multiple times in recent weeks without sustaining a break. When resistance levels that have been tested repeatedly finally break, it often signals that a new phase of the trend is beginning. The breakout was not on light volume. It was not a false breakout that would reverse within hours. It was confirmed by strong buying across all precious metals, by movements in currency markets, by shifts in bond yields. The 10-month pattern, combined with the PPI confirmation, created a specific setup, a setup that traders who study market history recognized immediately, a setup that suggested the easy part of the rally might already be over, but the significant part might just be beginning. The confusion began approximately 6 weeks ago, though most market participants did not notice it at the time. Silver was climbing steadily while official inflation metrics were supposedly declining. The consumer price index showed moderation. The Federal Reserve was signaling confidence in its inflation-fighting strategy. Economic commentary suggested the worst was behind us, yet silver kept rising. This created a puzzle that very few analysts bothered to examine. Why would an inflation-sensitive asset rally aggressively during a period when inflation was reportedly under control? The standard explanation offered by mainstream financial media was thin and unconvincing. They called it speculative excess. They suggested retail traders were irrationally chasing momentum. They pointed to technical factors and ignored fundamental ones. But markets are not irrational for extended periods. Speculation creates sharp moves that reverse quickly. What was happening in silver was different. It was sustained, methodical, the kind of price action that reflects repositioning by informed capital rather than gambling by uninformed retail. The real explanation required looking beneath surface-level data at what was actually happening in the physical economy, at the places where inflation shows up first, before it appears in government statistics, at the producer level, at the manufacturing level, at the commodity input level. This is where the divergence lived. Official consumer inflation data captures what households pay for finished goods. It measures the endpoint of the supply chain. But inflation does not start at the endpoint. It starts at the beginning. It starts with raw materials, with energy costs, with labor costs at the production level. These pressures build in the producer economy for months before they fully translate into consumer prices. Producer price index data measures this earlier stage of inflation. It captures what manufacturers and producers are paying for inputs before those costs get passed to consumers. When PPI runs higher than CPI, it suggests that producer-level inflation has not yet fully flowed through to consumer-level inflation. It suggests there is inflation in the pipeline that has not yet appeared in the headlines. For the past several months, this is exactly what had been happening. PPI had been running hotter than CPI. The gap between the two was widening. Producers were absorbing higher costs rather than immediately passing them to consumers. They were compressing margins, delaying price increases, hoping input costs would moderate, so they would not have to test consumer price sensitivity. But costs were not moderating, they were accelerating. And eventually, businesses cannot absorb those costs indefinitely. Eventually, they must pass them through. That moment of pass-through is when consumer inflation catches up to producer inflation, when the lagging indicator finally reflects what the leading indicator has been showing for months. Silver was not reacting to current consumer inflation numbers. It was front-running the inflation that PPI data suggested was coming. The metal was pricing in what had not yet shown up in the statistics that journalists and analysts focused on. This is what sophisticated capital does. It does not wait for confirmation in lagging data. It positions ahead of what leading indicators suggest is approaching. Thursday's PPI report confirmed what silver had been signaling for months. Now, the 2.9% headline number was not the critical piece. The critical piece was the acceleration. PPI had been expected to moderate. Instead, it accelerated. Core PPI, which economists watch more closely because it strips out volatile components, jumped to 3.6% against expectations of 3.0%. That 60 basis point miss was not statistical noise. It was a regime change signal. It suggested that the disinflationary trend that had dominated the second half of the previous year had stalled or reversed. It suggested that the Federal Reserve's assumptions about inflation's path might be wrong. It suggested that the factors driving producer costs higher were more persistent than policy models anticipated. What factors were those? The data pointed to several culprits operating simultaneously. Energy costs were a primary driver. While crude oil prices had stabilized in recent months, natural gas prices had spiked due to weather-related demand and constrained supply. Electricity costs for industrial users had risen substantially. These energy inputs affect nearly every manufactured product because energy is required at multiple stages of production and transportation. Labor costs were another factor. Wage growth at the producer level had not moderated as much as economists expected. Workers were demanding and receiving higher compensation. In industries facing labor shortages, wage pressure was particularly acute. These higher labor costs get embedded in the cost structure of goods. Supply chain disruptions, though less severe than during the pandemic, had not disappeared. Certain critical inputs remained difficult to source. Lead times remained extended. Companies were paying premiums for reliability and speed. These costs were flowing through to final producer prices. Then there was something less tangible but equally important. Inflation expectations themselves. When businesses expect costs to keep rising, they adjust their pricing strategies preemptively. They build in cushions. They pass through expected future cost increases before those increases actually materialize. This creates a self-reinforcing dynamic where inflation expectations feed actual inflation. The precious metals market, particularly silver, had been reading these signals in real time through other channels, through commodity futures markets, through shipping cost data, through anecdotal reports from industrial users, through currency market movements that suggested international capital was losing confidence in central bank inflation narratives. When PPI data finally confirmed what these alternative data sources had been suggesting, silver did not rally because the information was new. It rallied because the information was now official. It rallied because the data that policymakers and institutional investors rely on had finally caught up to the reality that forward-looking markets had already priced. The 10-month winning streak in silver was not random. It was the market systematically repricing inflation risk as evidence mounted month after month that official narratives about inflation's defeat were premature. Each month that passed without a significant correction in silver was another month where the underlying inflation pressures proved more durable than expected. Thursday's PPI report was confirmation, validation, the number that turned what had been a suspicion based on leading indicators into a fact backed by official government data. And markets always respond more aggressively to confirmation than to speculation. Confirmation removes doubt. It forces participants who had been waiting for proof to finally act. This is why silver went vertical on the PPI release. Not because the data surprised the metal, but because the data surprised everyone else. There exists a specific mathematics in markets that most participants never learn. It is not the mathematics of valuation models or discounted cash flows. It is the mathematics of supply constraints meeting demand surges. The mathematics of what happens when a physical commodity cannot expand its supply quickly while investment demand accelerates rapidly. Silver operates under a unique set of constraints that make it behave differently than almost any other traded asset. Understanding these constraints is essential to understanding why the current 10-month rally might be communicating something far more significant than a typical bull market in a commodity. The first constraint is the dual nature of silver itself. It is simultaneously an industrial metal and a monetary metal. This duality creates demand dynamics that do not exist in other markets. As an industrial metal, silver is consumed. It goes into solar panels that get installed on rooftops and never return to the market. It goes into electronics that get used and eventually discarded. It goes into medical applications, water purification systems, electrical contacts, batteries, and hundreds of other industrial processes. Approximately half of all silver mined each year gets consumed in industrial applications and effectively disappears from available supply. As a monetary metal, silver is hoarded. Investors buy physical bars and coins and hold them as stores of value. Unlike industrial consumption, this silver could theoretically return to the market if prices rise enough to incentivize selling. But in practice, monetary demand often strengthens precisely when industrial demand is also strong, creating a compounding effect on available supply. Gold faces only monetary demand. Copper faces only industrial demand. Silver faces both simultaneously. When both types of demand accelerate at the same time, the supply response cannot keep pace. The second constraint is production inflexibility. Silver is not like oil, where producers can drill new wells relatively quickly when prices rise. Most silver comes as a byproduct of mining other metals, primarily copper, lead, and zinc. Only about 30% of global silver production comes from primary silver mines. The rest comes from mines that are extracting other metals and getting silver as a secondary product. This means that when silver prices rise, producers cannot simply decide to mine more silver. Production is constrained by the economics and geology of the primary metals being extracted. A copper mine does not increase production because silver prices went up. It increases production if copper prices justify the investment. The silver that comes along is simply a byproduct whose volume is determined by copper extraction rates, not silver market conditions. When investment demand for silver surges, as it had been doing progressively over the past 10 months, the supply response is muted and delayed. New primary silver mines take years to develop. Byproduct silver production cannot scale quickly. The only immediate source of new supply is recycling and existing inventories. This brings us to the third constraint, inventory depletion. The major silver inventories tracked by commodity exchanges had been declining for months. The COMEX warehouses in New York, the primary hub for silver trading in the Americas, had seen registered inventory fall substantially. Registered inventory is silver that is available for delivery against futures contracts. When this inventory declines, it suggests that physical silver is being withdrawn from the exchange system and moved into private hands where it is not available for immediate sale. The London vaults, which store silver for the global market, showed similar patterns. Withdrawals exceeded deposits. Physical metal was leaving the exchange system. This was not speculation. These were public inventory reports published by the exchanges themselves. When exchange inventories decline while prices rise, it creates a technical setup that commodity traders recognize immediately. It suggests that the paper market, where futures contracts trade, is becoming disconnected from the physical market, where actual metal changes hands. Paper contracts can be created infinitely through leverage. Physical metal cannot. The fourth constraint is the leverage embedded in the futures market. In commodity futures, participants can control large quantities of a commodity by posting only a small percentage as margin. This leverage amplifies price movements in both directions. But leverage creates a specific risk when physical inventories are declining. If a substantial number of futures contract holders decide they want physical delivery instead of cash settlement, the system faces stress. There are far more paper claims on silver through futures contracts than there is physical silver available in exchange warehouses. Under normal conditions, this is fine because most contracts settle in cash. But when confidence in paper claims declines and physical demand increases, the leverage that made the system efficient becomes the vulnerability that makes it fragile. Thursday's price movement to $92 occurred in both physical and paper markets simultaneously, but the intensity was greater in physical markets. Premiums for physical silver coins and bars over the spot paper price had been widening. Dealers were reporting delays in obtaining inventory. Mints were rationing production. These are signs that physical demand is exceeding what the current supply chain can smoothly deliver. The fifth constraint, and perhaps the most important for understanding what silver was signaling, is silver's role as a monetary pressure gauge. Throughout history, when confidence in fiat currency systems begins to crack, silver responds before gold. It is more volatile, more accessible to smaller investors, and more responsive to shifts in monetary sentiment. Gold is the asset that central banks hold. It is the reserve asset that validates itself through institutional adoption. Silver is the asset that individuals hold. It is the metal that ordinary people accumulate when they lose faith in their currency's purchasing power. The 10-month rally in silver was not just about inflation data or supply constraints. It was about a growing segment of global capital concluding that the monetary system had fundamental problems that would not be solved by the policy tools currently being deployed. It was about people converting currency into metal because they trusted metal more than they trusted the promises backing the currency. This is what made the PPI confirmation on Thursday so significant. It was not that the number surprised silver investors. It was that the number validated, with official government data, what silver's price action had been suggesting for 10 consecutive months. That inflation was not under control, that the monetary authorities did not have the situation contained, that the policies being implemented were not producing the results being promised. Silver was the messenger. PPI data was the message arriving in a form that could no longer be dismissed as speculation or conspiracy. When a government agency publishes data showing producer inflation running substantially hotter than expected, it becomes difficult to maintain the narrative that inflation has been defeated. The mathematics of silver's supply constraints meant that once this realization spread beyond the early adopters who had been accumulating for months, the price response could accelerate rapidly. There was not enough physical supply available to satisfy a sudden surge in investment demand. The leverage in the futures market meant that even modest physical buying could move paper prices substantially. The inventory depletion meant there was no buffer of immediately available metal to absorb demand surges. All of these mechanical factors were in place before Thursday's PPI report. The report simply served as the catalyst that brought broader attention to what the structure of the silver market had been communicating quietly for months. The canary had been singing. Thursday was the day that people finally stopped and listened. History does not repeat itself with precision, but it does establish patterns that thoughtful observers can recognize and use as navigational guides. The 10-month winning streak in silver, now validated by official inflation data running hotter than expectations, created a pattern with only two meaningful historical precedents in the modern era. Both of those precedents were followed by market conditions that redefined wealth for those who understood what was unfolding. The first precedent was 1979. Silver began that year trading around $6 per ounce. It ended the year approaching $50. A 10-month uninterrupted rally that culminated in one of the most spectacular price surges in commodity market history. The context was double-digit inflation, a Federal Reserve that had lost credibility, a currency crisis in the dollar, and a crisis of confidence in the entire monetary system. The second precedent was 2011. Silver rallied for 10 consecutive months from late 2010 into early 2011, moving from approximately $18 to nearly $50. The context was quantitative easing programs by central banks globally, sovereign debt crises in Europe, and fear that paper currency debasement would accelerate indefinitely. Both periods shared common characteristics: loss of faith in central bank credibility, inflation that proved more persistent than authorities predicted, monetary policy that appeared impotent to address underlying economic dysfunction. And in both cases, silver's sustained rally was not the cause of these conditions, but the symptom. The market was sending a message about systemic problems. The current 10-month rally exists in a similar context. The Federal Reserve has been insisting that inflation is transitory, then persistent but manageable, then declining steadily. Each narrative has been adjusted as previous narratives failed to match reality. The PPI data released Thursday suggested that the current narrative, that inflation is being successfully controlled, might also need revision. But patterns from history provide guidance, not guarantees. The question facing market participants now is not whether silver's rally will continue indefinitely at the same pace. That is statistically improbable. The question is what the rally is indicating about broader conditions, and what those conditions mean for different types of capital allocation. For those holding physical silver already, the decision framework is straightforward. The 10-month pattern suggests that the factors driving demand have been durable, not transient. The PPI confirmation suggests those factors remain in place. Physical holders who accumulated during the early months of the rally have unrealized gains that are substantial. The decision is whether those gains should be protected through partial profit-taking, or whether the pattern suggests holding is appropriate for the next phase. History offers conflicting guidance here. In 1979, those who took profits at $30 missed the move to $50. Those who held to $50 and did not sell saw prices collapse back to single digits within months. In 2011, similar dynamics played out. Timing the exact top of a parabolic move is nearly impossible. But understanding that parabolic moves always end, often violently, is essential. For those who do not yet hold silver but are evaluating whether current levels offer acceptable entry points, the calculus is different. Buying an asset after a 10-month rally and a breakout to multi-year highs is buying momentum, not value. Momentum strategies can be profitable if the trend continues, but they carry the risk that entering late means absorbing maximum volatility with minimum remaining upside. The alternative perspective is that if silver is signaling a broader monetary system problem, then current prices might still be early relative to where prices could go if that problem intensifies. This requires a judgment about whether the underlying conditions driving the rally are early stage or late stage. That judgment depends on views about inflation trajectory, central bank policy effectiveness, and global monetary stability. For those holding portfolios of traditional financial assets, stocks, and bonds, the silver rally and its PPI confirmation presented a different kind of message. It suggested that inflation risk has not been eliminated, that real returns on fixed income might be negative if inflation remains elevated, that equity valuations predicated on low inflation and low interest rates might face pressure if inflation proves stickier than priced. This creates a strategic question about portfolio construction. Traditional diversification assumes that stocks and bonds move inversely during most market conditions, providing balance. But during inflationary periods, stocks and bonds can both decline simultaneously while hard assets appreciate. The 1970s demonstrated this dynamic clearly. The current silver pattern suggested that relying exclusively on traditional asset allocation might be insufficient if inflation remains problematic. The response to this recognition could take several forms. Some institutional investors were already increasing commodity exposure, not just in silver, but across the complex. Agriculture, energy, base metals. These are real assets that tend to hold value when currency purchasing power declines. The allocation did not need to be large to provide meaningful portfolio protection. Even a 5 to 10% allocation to commodities could reduce overall portfolio volatility during inflationary periods. Others were examining inflation-protected securities, though these carried their own complications. Government-issued inflation-linked bonds provide some protection, but their returns are tied to official inflation measures that may not capture actual inflation experienced by individuals. If official CPI understates real inflation, as many argued, then inflation-protected bonds would underperform relative to true inflation hedging. For businesses operating in the physical economy, the PPI data and silver's confirmation carried operational implications. If producer costs were rising faster than consumer prices, margin compression was inevitable unless businesses could pass through costs. This created strategic decisions about pricing power, cost structure, and inventory management. Companies with pricing power could raise prices to maintain margins. Companies without pricing power faced declining profitability. The ability to differentiate between these two types of businesses became crucial for equity investors trying to navigate an inflationary environment. Silver's rally was a signal to examine which companies in a portfolio had genuine pricing power and which were vulnerable to margin compression. For policymakers, though they rarely acknowledged it publicly, silver's behavior was an embarrassment. The metal was essentially voting against the effectiveness of current monetary policy. It was suggesting that markets did not believe inflation was under control, regardless of what official statements claimed. When a commodity that serves as an inflation barometer rallies for 10 straight months and then surges on worse than expected inflation data, it undermines the credibility of assurances that everything is fine. The Federal Reserve faced a dilemma. If they tightened policy aggressively to combat inflation, they risked triggering recession. If they remained accommodative to support growth, they risked allowing inflation to become embedded in expectations. Silver's rally suggested that markets believed the Fed was behind the curve, that inflation had already become more embedded than the Fed was willing to admit. This policy paralysis created opportunity for those positioned correctly and risk for those who were not. The opportunity was in assets that benefited from inflation or currency debasement. The risk was in assets that assumed stable prices and stable currency values. The 10-month pattern in silver was not a prediction of immediate market collapse or currency crisis. It was a warning signal that conditions existed which could produce those outcomes if they intensified. It was information that allowed those paying attention to adjust positioning before problems became obvious to everyone. What happened next would depend on whether the factors driving the rally intensified or moderated. If PPI data continued showing elevated producer inflation that eventually passed through to consumers, silver's rally likely had further to run. If producer costs stabilized and inflation genuinely moderated, the rally could stall or reverse. But the pattern had already provided value to those who recognized it early. 10 months of sustained gains, a breakout confirmed by fundamental data, a historical precedent that suggested significance. Whether an individual chose to act on that information and how they chose to act determined whether the pattern translated into preserved or enhanced wealth. The canary had sung its warning. The PPI data had validated the song. What remained was the question every market participant must answer individually. What does this information mean for my capital, my risk tolerance, and my time horizon? The pattern provided context. The execution required judgment.